Sometimes you just got to tip your hat and respect the performance of a gold producer. This quarter, that honor goes to Equinox Gold, whom has seemingly placed their operations on the right track despite some speed bumps experienced earlier this year. Post closing of their acquisition of Calibre Mining, they've got a refreshed management team that, by all appearances, is ready to perform, with costing coming down and production moving up, even if you want to exclude the new assets that Calibre brought into the mix. And we're not the only ones who hold that opinion. The markets last Thursday rewarded the company with a 15% bump, followed by a further 2% gain on Friday, with the stock gaining just shy of 24% or $1.54 a share last week. On that note, let's dive in. Equinox Gold in the second quarter of 2025 posted top-line revenue of $479 million, which was an improvement of 78% on a year-over-year basis from $269 million, and an improvement of 13% on a quarter-over-quarter basis from $424 million in the first quarter. That revenue was off the back of gold sales of 149,000 ounces at an average price of $32.07 an ounce, versus 115,000 ounces in the year-ago period that were sold at an average price of $23.28 an ounce. And before you say it was all Calibre, we dug a bit deeper into the filings, and it really wasn't. Sales from the Calibre assets in Q2 totaled just 1,000 ounces, which came from the Pan mine. Given the fact that the transaction closed June 17th and the quarter closed June 30th, no sales were recorded from the Nicaraguan assets, and well, mining ops at Valentine aren't set to begin until this month. So that was just some good-natured performance improvement on Equinox's part. Income from mine operations, meanwhile, grew from 21 million to 160 on a year-over-year basis, an improvement of 654%, which is largely attributed to a higher gold price driving revenue higher. That same line item was up from 34 million on a quarter-over-quarter basis, which was a function of salaries and site administration expenses coming in lower in Q2. Net income, however, was down from 354 million or 90 cents per share to 24 million or 5 cents per share year over year. However, last year's figure was heavily skewed as a result of a gain on the remeasurement of previously held interests in Greenstone to the tune of $580 million. Quarter over quarter, things were less dramatic, with Q2 net income coming in higher than Q1's $76 million net loss. On an adjusted basis, Q2 net income totaled $57 million or 11 cents per share, as compared to Q1's loss of $37 million or 8 cents per share, and Q2's 2024 net loss of $46 million or 12 cents per share. Adjusted EBITDA, meanwhile, improved from $45 million last year to $201 million this year in the second quarter. Operating cash flow before changes in non-cash working capital improved to $126 million, up from $73 million in the prior quarter and from $40 million in the year-ago period, while cash and cash equivalents rose to $407 million, up from $173 million at the start of the quarter. Despite the improvements, however, net debt hit a new high at $1.4 billion versus $1.2 billion at the end of Q1 and $1.3 billion in the year-ago period. Moving along to the production data, Equinox was rather open about their production figures this quarter. First, they provided data in terms of gold produced from operating assets included in the 2025 guidance, which sits at 219,000 ounces. But then they backed out the production that occurred from the Calibre assets before the close of the deal, with total gold production in Q2 standing at 151,000 ounces in terms of what is attributable to Equinox, with 1,000 of those ounces coming from Calibre assets post-closing. Production comparatively was up from 145,000 ounces in Q1 and from 122,000 ounces in Q2 of last year, reflecting a 23% improvement on a year-over-year basis. On a site-level basis, Greenstone was the big producer this quarter, with total production of 51,000 ounces of gold versus 44,000 ounces in the first quarter. But it still hasn't returned to their quarterly high production level of 53,000 ounces, which was achieved in the fourth quarter. And grades continue to decline, falling from 1.06 grams per ton in Q1 to 0.92 grams per ton gold in Q2. However, that was offset by recoveries improving from 80.7% to 85.1% and a 21% increase to tons processed, which came in at 2 million tons. Aside from Greenstone, Arizona produced 19,000 ounces versus 16,000 in Q1. Bahia produced 31,000 ounces versus the previous 28,000 ounces, and RDM produced 14,000 ounces versus 11,000 ounces previously. Mesquite, meanwhile, produced 31,000 ounces versus 12,000 ounces in Q1, rounding out improvements across the board versus the prior quarter. And as for the Calibre assets, Q2 saw the Nicaragua operations produce 65,000 ounces, none of which were technically attributable to Equinox, while the Pan mine in Nevada produced 83,000 300 ounces, of which 1,000 were attributable. Valentine again had no gold production. However, Equinox did advise that ore processing is expected to begin in late August here, with the first gold pour to occur by the end of Q3, with $54 million in expenditures expected to occur before production really gets underway. Anyways, in terms of costing, Q2 was a positive one for Equinox on a per ounce basis. Cash cost came in at $14.78 an ounce, which might sound high, but is a big improvement over the $17.69 figure posted in Q1 and the $17.47 an ounce figure from Q2 of last year. All-in sustaining costs similarly improved, falling below the $2,000 an ounce mark to $19.59, as compared to $20.65 an ounce last quarter and $20.41 in the same quarter of last year. As for guidance, things remain on track for Equinox, which I mean, they probably should be on track, considering the guidance was literally updated in mid-June after disappointing early results from Greenstone that reduced production estimates and ballooned cost estimates. Current production guidance is calling for consolidated production of 785 to 915,000 ounces, with the first half production sitting at 401,000 ounces, meaning the company is firmly on track. Cash costs, meanwhile, are expected to come in a range between $1,400 to $1,500 on a consolidated basis, while AISC is expected to be in a range of $1,800 to $1,900 an ounce. The first half production currently has cash costs at $1,420 an ounce, which is right on target, while AISC is at $1,732, slightly below the targeted range, which is also positive. Alright, so let's wrap it up. Equinox, by all accounts, appears to be back on track after what was a poor Q1 showing. Production improved across the board and costing came down as a result, and well, investors liked it. With the announced sale of the Nevada assets for $115 million earlier this month, hopefully they can start to work to pay down some of that debt, especially while margins are strong on every ounce sold. All right, everybody, thanks for watching. If you have thoughts on Equinox's earnings, please let me know in the comment section. We're also trying to get Ross Beatty back on the channel so we can ask some questions about Equinox, because the last time we had him on, we got a lot of views and people really like that interview. So hopefully he will hop back on. If there's stories you want us to cover, as always, let us know in the comments section. If you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. And also, folks, if you want more mining content, check out our website over at thedeepdive.ca. All right, everybody, thanks for watching.